Mike, thank you for joining us on Capital and Power. And our attention right now, despite all of the global issues, is focusing on what's going to happen next week with Nvidia and the GTC. And with YieldMax, I'm curious, what options, what are the options markets signaling ahead of what Nvidia is going to be sharing with us next week?
Yeah, so obviously it's a big week. I mean, we're talking about the biggest company, and it's a big week for them. It's a pretty simple thing when you're taking a look at the options market for anybody to divine essentially what it's indicating. There's really two things that you'd probably want to look at as you examine the options markets to give yourself a little bit of a sense of what it's forecasting. The first is to take a look at how big the implied move in the underlying stock is and whether that's considerably larger or not for a specific event. The way that individuals can do that very easily, if you just have a brokerage platform, even if you just have access to some of the free financial services that are available, you can just take a look, because all of these stocks now have what we call weekly options. And actually, in the case of the Mag 7, options that expire in the middle of the week. So you can really pinpoint with tremendous accuracy when moves are anticipated. And you simply take a look at the price of the call and the put that are basically at the money. So in fact, I will actually do this. You don't need to see it, but I'm going to just pull this up on another screen and we'll see what we have here. So I'm going to just take a look, for example, at the options that expire on March 20th. So that's going to be a week from this coming Friday. Stock right now is trading around $179. The closest strike to that expires on the 20th are the 180s. The calls are about $5.80, and the puts are about $6.65, $6.70. So we put those two together, and we get $12.50. So $12.50 is the implied move. That's the expected move for Nvidia between now and a week from this coming Friday. And then in terms of just what the sentiment is, you can take a look, as this is really a heuristic, but it's probably helpful. And that is simply take a look at whether calls are out trading puts or puts are out trading calls and whether that volume is unusual. Nvidia is a name that it generally has a bullish sentiment. People like this stock, and that remains true today. It's been true for the last 20 days. Calls have outpaced puts by about 50%, and they're outpacing them again today.
So for a Luddite, let's go back to that $12 move, percentage-wise. Put that into context for me. Low, high, fairly priced. What is it telling me from a percentage point?
Yeah, so I guess one way to think about that is so I'll just do the math on that. That's close to 7%. So 7% over the course of 2 weeks is a pretty big move. That would be above average. If we think about this, what does the market move on any given day? If we think about it, maybe a 50 basis point move would be a pretty good size move for the S&P, right? A 1% move would be large. Now, as you pointed out before we got going, we're in an interesting environment right now, and volatility in almost all risk assets has increased as a result of what's going on the geopolitical front. So we do need to understand that that's going to have a little bit of an influence. It doesn't really matter, obviously it's going to have a big impact in things that are unrelated to Nvidia's GTC, like oil, but it has an impact on all equities, right? So as the underlying situation gets choppier, you're gonna see that take place in single stocks too. But a 7% move over a 2-week time frame is pretty good, especially for a company that's over $4 trillion.
How much of that move, though, is motivated by or generated by the turmoil in the Middle East? I mean, I would imagine it's very little, given the impact of what's happening in Iran and with Israel and the United States and the rest of the Middle East. How would that volatility impact Nvidia?
Actually, I would say this is pretty easy to deduce, as a matter of fact. So we know that Nvidia is the largest constituent of the NASDAQ 100. It's the largest constituent of the S&P 500. If you take a look at the VIX index, which is a measure of the market's expectation of volatility for the S&P over the course of the next 30 days, right now the VIX index is about 28. What is it normally? 16, 15. And what is going to be the biggest market capitalization swing in the publicly traded universe of stocks if the markets really start swinging around? And the answer is simple. it's Nvidia. And of course, it's going to be some other names too. You're going to see the Amazons, Apples, and Microsofts of the world. But yeah, of course. I mean, it's not that difficult to do the math. We can also take a look at the implied volatility shifts in Nvidia as well. I mean, options premiums will rise when uncertainty increases. Uncertainty has increased for reasons that are geopolitical in nature. But in Nvidia's case, of course, it's the idiosyncratic thing that relates to GTC that's also going to cause an increase. So would you normally expect to see a 7% implied move in Nvidia over the course of less than 2 weeks? No.
Well, let me ask you, and then I want to get into YieldMax and what you folks are doing quite successfully. But how should it, again, as a Luddite, as an investor, how should I think about, for instance, single stock exposure, and you've touched upon this, versus diversified semiconductor income funds? I mean, what should I be focusing on?
Yeah, it's interesting. Of course, when you take a look at, a diversified semiconductor portfolio, we run a couple of these. It will be somewhat more diversified than, say, one big technology stock like Nvidia. And we have seen some pretty big divergences within the chip space. So if you look back to the beginning of the second half of 2025, this is a period of time when hardware started to wildly outperform software. So if you take a look at the first half of 2025, software and hardware tracked almost lockstep with one another. From the beginning of the second half until the end of the year, hardware outperformed software by 17.5%. From the beginning of 2026 up until about 2 weeks ago, hardware outperformed software by about 23%. So a shorter period of time, bigger outperformance. We're talking about 40% relative outperformance if you're looking at the two biggest names in the respective spaces. On the software side, that's going to be Microsoft. On the hardware side, that's going to be Nvidia. Huge divergence there. Now, we did see big dispersion, though. That's the difference between how individual constituents in the hardware space performed relative to each other. Look at Micron Technologies. Micron Technologies was one of 2025's absolute hardware rock stars. If you take a look at NVIDIA's performance, basically from the beginning of the fourth quarter through the end of 2025, it was dead flat, little change so far this year. So you do get the benefits of diversification to some extent when you decide that you're going to focus on some industry group like hardware technology, chips, semis, that kind of thing. But do bear in mind that there is some diversification, but it's not entirely diversified when you decide you're going to focus on that area.
Okay, so let's talk about YieldMax. And if you want to share your screen, please do. I welcome that. So investors notice right away when you talk about YieldMax ETFs is the high distribution yield.
Yeah.
Explain, and again, for me, I'm not the brightest ticket when it comes to investing, but explain in simple terms how those payouts work, how often investors receive them, and what's actually driving that income.
Sure. So YieldMax ETFs has a number of what we call options income ETFs. At a very high level, you get exposure to the underlying asset. Most of these funds have long exposure, but some have short exposure. That exposure can come in one of three basic flavors. That can either be that the fund is either long or short the underlying stock. It could have a total return swap, for example, on the underlying stock, or it could have what we call a synthetic. So it is possible to use options to essentially create a long or short exposure in the stock. And then once you have that, you then sell options premium around that. For most of our funds, we sell something called a call spread. So an upside call simply entitles the holder the right but not the obligation to buy the underlying asset. So you can imagine if you own Nvidia and you sell an upside call against it, you're essentially collecting a premium now in exchange for giving somebody else, the buyer of that call, the right to buy that stock from you. We use call spreads rather than just selling upside calls. And the reason we do this is because the way stocks behave is that they tend to be relatively quiet for a period, and then they start to move around much more sharply. And then they are quiet, and then they move around more sharply. And by selling a call spread, when an individual stock moves very sharply higher, we still get to participate. So we will have been continuously selling off the right to somebody else to buy it, but we keep an upside call kicker so that if the stock moves up, let's say 15% in a week, we hope to capture, 75 to 80% of that upside move while we've been collecting these premiums all along.
Okay, so how do you pick the company that gets a YieldMax ETF? For example, What makes a stock a good candidate for one of the option income strategies that you're describing?
Well, the truth is it's investors that choose. And we can actually look at the markets and say, okay, what do people obviously care about? Options volumes tell us a lot about what individual investors are interested in. Now, some of these are going to be obvious. Nobody needs to get a cue card that says, hey, Nvidia is a popular stock, and people care a lot about what's going on there. Same thing is true for some of the other Mag 7 stocks. But actually, if you take a look at options volumes, that's going to tell you volumes about what it is that investors care about. So generally speaking, the stocks that are going to end up in the YieldMax portfolio of ETFs are going to be stocks that have very high options volumes because investors have already indicated, one, an interest in the underlying stock, and two, in option strategies on those stocks. So we kind of take our cues actually from the market. I think that's probably the best approach. If you ran a grocery store, you end up ordering more of the things that people buy all the time.
I was a bag boy at Publix a billion years ago, so I cannot. Grocery stores I understand, but I think, like a lot of ignorant people, and I want to say ignorant because I think there are people who understand options and extracting value from these kinds of trades, but they make me afraid. And then when I hear terms like synthetic covered calls, in a rudimentary explanation, I love the idea of not having to actually hold 100 shares of an individual stock, but I would never go near with a 10-foot pole because it would blow up in my face. But when you offer that to a client, the ETFs, they look attractive, especially with the income potential, but how volatile can they be, especially when we're talking about a synthetic covered call?
Yeah, so the synthetic covered call, the reason we use synthetic covered calls rather than in those single stock option income ETFs actually has to do with what are called RIC rules, the Registered Investment Company rules. That's the 1940 Investment Act that regulates mutual funds, and it regulates exchange traded products like ETFs. So those funds basically, for the most part, hold U.S. Treasuries, and then they take a synthetic position in the underlying stock using options, largely so that they can still comply with the diversification rules that apply to funds of this type. It really, from a risk and return perspective, is going to behave functionally almost identically to an underlying stock position. So to create a synthetic, you simply buy a call of a given strike and expiration, and then you sell a put of the same strike and expiration. If the stock is above the strike, the call is in the money, you buy the stock at the strike. If it is below the strike, the put is assigned, and you buy the stock at the strike price. So, and this synthetic is going to be priced commensurate with the forward price of the underlying stock. So, it sounds complicated. It really has to do with just making sure that these are structured in a way that's compliant with the SEC rules about funds of this type.
But does this, again, I'm trying to understand this in a short period of time. You've spent years doing this and becoming an expert in it. Does it minimize the volatility, or the volatility still exist? For instance, if the stock for some reason should have some kind of huge volatile move, you're going to get hit.
I can actually, and this is, I'm going to at this point share my screen, and I'm going to compare, because we've been talking about Nvidia, and because it's the most broadly held stock, I guess we could say. We're going to take a look at it since the beginning of the fourth quarter of last year, and we're going to compare our fund NVDA. So just one quick thing about what this chart is. This is what's called a total return chart. What is a total return chart? A total return chart calculates the amount of returns that an investor receives, net of the changes in the price of the underlying security, plus the distributions they get. So if you had a stock and it paid a 6% annualized dividend, to think about your returns at the end of the year, you would want to know the change in the price of the stock plus the 6% dividend that you received. In our case, our funds pay fairly substantial distributions on a regular basis. The cadence for NVDA, for example, is weekly. So investors in this fund are getting weekly distributions. And in this case, I'm just looking at NVDA, which is our Nvidia options income ETF. So it's a single stock exposure, using a synthetic, selling upside call spreads. And this is since the beginning of the fourth quarter of last year. And people will notice that, and I'm sure they've observed, Nvidia has risen, it has fallen. It hasn't really changed that much since then. If we take a look at it right now, it's down about 3.5%. since the beginning of the fourth quarter. And the YieldMax NVDA, which is the options income ETF on Nvidia, is up about 1.84% in terms of total return. So it's outperformed the underlying stock by a little over 5% in less than 2 quarters. But the more important observation I would encourage people to make is that you will notice that the white line, that's the NVDA, the option income ETF, moves around less than NVIDIA does. So take a look at the biggest drawdowns in NVIDIA, and you'll see that they are larger than the biggest drawdowns in NVDA. And you'll notice that the upside moves are also. So by collecting
the volatility, what I'm seeing, tell me when I get it wrong, I'm seeing that actually the perception of this being, the synthetic covered call options being perhaps more volatile, what I'm actually saying is actually in this case, less volatility essentially.
Well, they will generally be less volatile. Even the ones that have performed badly because the underlying stocks did very badly are considerably less volatile than the stock is over the course of time. And this should make intuitive sense to an investor. If you think about it, if I invest in something and it makes regular distributions to me, that is probably going to exhibit lower volatility than an asset that never does. A zero coupon bond is typically going to be more volatile and take more risk in duration terms than one that pays regular coupons. Any kind of situation where you're pushing the duration out, generally speaking, you're going to start seeing higher volatility. Now, I want to make a different point. It's not that these things come without a trade-off. There is a trade-off. If a stock, shoots up and never drops, all it does is just rise straight to the moon. You just as soon own the stock. You don't want to sell off any upside. You could care less about getting premiums in that event. But that's not how most stocks behave. And the difference between these things is something we call the volatility risk premium. It's the little bit of excess returns that you expect to make from selling options because options are a form of insurance. So insurance doesn't, it's not that insurance companies get to keep the premiums and never make a payout. The idea is that indeed sometimes you do make a payout. The hope is that the premiums you collect exceed the value of the payouts you make when and if and as you have to make them.
So as we wrap this up, what do you want to leave people? What's the message you want to leave the people watching?
Well, I think there's different types of investors. And, from our perspective, the most important thing is that there are people who want to avail themselves of strategies that use options, but are probably either intimidated by them, which is completely fair, or they might just find that it's logistically too challenging. I mean, options that expire weekly, if you're going to trade a stock and then trade options on that stock, and those options expire every week, one stock, that's 50 trades a year. If you have 20 stocks in your portfolio, you can see that this becomes pretty untenable. And that's assuming that the only trade you ever do is an adjustment from one week to the next, not responding to changes that the market itself might give you. For most people, that's logistically impossible. For me, it would be. I can't conduct 30, 40 trades in my personal account a week and still do my day-to-day job. Neither could you. Neither could most people. So one of the reasons that these ETFs exist, ours and others that also offer similar products, and sometimes they offer different types of option strategies, but packaging them into an ETF gives people the ability to buy something that is a strategy that uses options, but trades like a stock, which is something that for most people it's easier, it's more familiar to them. And sometimes it can also offer some tax advantages as well. They tend to be more tax efficient sometimes than individual investors just trading in their own account might be.